when you're starting out and your net worth is under $2 million, just start with the basics, right? Just go out and buy some rental properties and then the syndications, like focus on just building the base. Part of it is let's get you addicted to investing. It's a young man's mistake to just shoot for the moon initially, specifically calling out like we have a subset of investors like this. Like, I don't want to offend you guys, but it's the guy who works in the tech field making $300,000 a year right out of college. And they think that because they're in the tech field, they're going to go make $25,000 venture capital investments. Sure, they know that they're probably going to lose money on most of them or all of them. But what's more likely to happen in that case for a new investor who's not connected is that they lose all their money just in the bad projects, because that's just the nature of venture capital too. But I don't know. I think of it the opposite is like just invest in more stable stuff. And the more net worth you have, that's when you get more risk tolerant. And that's when you go after more asymmetric type of plays, as opposed to the opposite, taking more risk up front or asymmetric plays up front. And then with the older you get, the more you decrease your risk tolerance. I guess now that I think about it, the traditional way of wealth building that Vanguard, all these companies say is when you're younger, go after the growth stocks more, the higher risk stuff. And then as you get closer to retirement, that's when you titrate down. I guess what I'm saying and what I'm emulating myself is the complete opposite of that idea. The comment here was angel investing is overrated, but investing as a LP in a venture capital fund makes sense. So you can invest in like little tech startups or even any brick and mortar startups. But what he's saying invest in a fund that might pool to go to a fund may invest in 10 different startups and you get the instant diversification that way. Yeah, it's a valid point. I'm sure a lot of people could make the complete opposite point. If you know who you're working with, the operator is so much more important in venture capital and businesses than it is real estate. I think that's where, as long as you have an operator who's honest and somewhat competent in real estate, it'll be all right. And that's where it flip flopped in angel investing. You can have a stupid idea, business plan, stupid idea. They're like, what? What's that? But if you have a proven operator who's more importantly connected, who can push a project to Wall Street and get it sold, get it IPO'd even, that's probably more important than what the actual idea was. But as an individual investor that you self-identify and the self-awareness of saying, hey, I'm all right. I'm a smart guy, but I don't know everything in venture capital. I don't know all the players. Then yeah, a fund makes sense. And that's where, like, from an investment point of view, if you're new to this, I think that's where the income fund makes sense because it's diversified into dozens of projects right off the bat. Where I think most people make the mistake of they want to invest in this particular investment because they want to have the pride of ownership there. See, again, same theme, right? That kind of gets people, whether it's their grandma's house or they want the pride of ownership of being in a syndication that buys 123 Main Street, 96 units in Arizona, whatever. What you want and what you go to initially isn't necessarily the best for you, especially in the early stages of learning this industry. But damn it, we all make the same mistakes. And that's what I'm here. And I had a recent call on this with several of my inner circle clients, and I made them very aware of this. If you guys want to do what you want to do, then by all means, do it. But my whole thing is at least know the other side and be somewhat aware of where you might have holes in your hypothesis. But yeah, the follow-up question, you asked a question like different investments or funds for different profiles. So I would say it's more, don't think of it as like income fund is only for the new guys or the older guys that are more conservative. Like, I think you need to do everything. You got to diversify over everything. And sure, maybe one profile may skew more towards income fund. Traditionally, the older folks who have looking more conservative, they'll be looking at the income fund for the diversification. The younger guys would not because they want to shoot for the moon. I actually think it's the complete opposite. The young guys should be being conservative and just, you got time on your side. You're already doing well. You're already on the tracks. Don't mess it up. The older guys, you got disposable income. So I'm just throwing that as a monkey wrench into people's thinking to shake you guys off of your probably traditional path of when you're younger, you take more risks. When you're older, you take less risk. I think a little bit of the complete opposite. But hopefully that just sets the set in more levels so you can come at this and figure out what's best for you more from a neutral position. What I do know is stocks are all-time highs, and it hasn't gone through its recession yet. Look at ITR Economics. They have their sine curve, and they got housing on the bottom right now, and everything else hasn't gone through that dive yet. People say we're probably in a recession now, even though GDP is positive. I talk to business owners. Everybody's has 20, 30% less orders. It's obvious. Sure, wages are still high, unemployment is still low, but if you talk to the business owners out there, that's not the case. And at some point, it's going to manifest its way out. But I do think we are heading to a very soft landing here where 2025 and beyond look very promising. But it could all lead to a 2030 crash.